Good morning everyone. I am Dr. Inak Lakshmi, Assistant Professor, Department of Commerce with Finance in Dr. SNSInstitutions College of Arts and Science, Coimbatore. I am here to explain the concept of marginal costing and break-even analysis. So, marginal costing and break-even analysis are the key concepts in managerial accounting that helps business make decisions about pricing, production, and cost control. First, we can see what is meant by marginal costing. Marginal costing is a costing technique that focuses on the additional cost incurred when producing one more unit of a product. It is concerned with the variable cost of production and excludes fixed cost from the cost of producing a specific product or service. So first we should know what is meant by fixed cost. Fixed cost remains constant regardless of the level of production. That is, the examples of fixed cost is rent and salaries. Variable cost, these changes with the level of production. That is, the examples of variable cost is raw materials, direct labor. What is meant by contribution? Marginal costing calculates the contribution per unit, which is the difference between the selling price and the variable cost per unit. This contribution helps to cover fixed cost and generate profit. So the formula to find out the contribution is contribution per unit is equal to selling price per unit minus variable cost per unit. Marginal costing is particularly used for decision making such as pricing decisions, make or buy decisions, product mix decisions, profit planning decisions. Now, I think we have got some inputs about marginal costing. Now we are going to see what is meant by break-even analysis. Break-even analysis, it is a technique used to determine level of sales needed to cover both fixed and variable cost, at which a point of company neither makes a profit nor a loss. That is break-even point. It helps business understand the sales volume required to start generating profit. What are the key components? Fixed cost is one key component. The cost that do not change with the level of production or sales is called as fixed cost. Variable cost, cost that vary with the level of production or sales is said to be variable cost. The price at which a product is sold is said to be the selling price, and contribution per unit is the difference between the selling price and the variable cost per unit. Now we can see what is meant by break-even point. The point is the level, break-even point is the level of sales at which total revenue equals to the total cost. That is, no profit, no loss. It can be calculated using some formulas. One of the formula is break-even point in terms of units is equal to fixed cost divided by contribution per unit. Now we have to find out what is meant by contribution. Contribution per unit equal to selling price per unit minus variable cost per unit. Alternatively, another formula is used to find out break-even point in terms of revenue. Break-even units into selling price per unit is said to be the breaking point in terms of revenue. Applications of break-even point. Applications of break-even point. What are the applications? Means profit planning. So helps managers predict sales needed to achieve the desired profit. Next is the cost control. It identifies the impact of changes in fixed or variable cost on the break-even point. Next is the planning strategy. Helps in setting the right price for the product to ensure profitability. Next is the investment decisions, useful for evaluating the feasibility of new project or products. So this is what about break-even point. Now we can see a small example of break-even, that is break-even calculation. When fixed cost is 50,000, selling price is 100 per unit and the variable cost is 60 per unit. Now we are supposed to find out the contribution per unit. Selling price minus variable cost, 100 rupees minus 60 rupees. That is 100 is the selling price and 60 rupees is the variable cost. 40 is the contribution. So break-even point in terms of units is fixed cost divided by contribution per unit. Fixed cost which is given as 50,000 rupees divided by 40 rupees, 1250 units is the contribution per unit. So the company needs to sell 1250 units to get the level of break-even. That is no profit, no loss. The conclusion is marginal costing and break-even analysis are the very powerful tools used in financial management, allowing business to make informed decisions about pricing, production, and cost management. They help in understanding how cost behave with changes in the production levels and sales, and in assessing the profitability of different business strategies. So, thank you so much for the patience listening.